let's get talking to a couple of companies then. Aarti Drugs is in focus. That stock is down around 2 to 3 odd percent. It reported what was a weak performance this time. The company's margins contracted while the API revenue fell as well. To discuss this and the outlook going forward, we have Adhish Patil, who's the CFO of Aarti Drugs, joining in. Adhish, welcome to the show. Well, let's start with the revenue decline this time round. It's been quite significant, and it's led by a decline in all of your segments: API, formulation, specialty, chemicals, intermediates. Tell us what took place, what resulted in the pressure.
Yeah, hi, good afternoon. So yes, this particular quarter, even the volumes were less. We were not expecting, actually we were rather expecting exports to pick up sooner, but it did not happen. I think the key reason remained the geopolitical tensions across the world. A lot of countries where we export to probably are still haven't got stabilized governments. A lot of elections are going on, because of which the government tenders are less, and in turn the API exports is little down. We saw, in fact, a lot of volume degrowth in exports this particular quarter, even though our gross contribution margins improved year on year as well as quarter on quarter. On the standalone basis, that is a major segment which we have, API and Spec Chem segment. But because of the lower operations, means you can say operating leverage was quite low, because of which the EBITDA margins got impacted quite severely this particular quarter.
All right, as we're speaking about that, just hold on to those thoughts, Adhish, because we have numbers at the bottom of your screen. One conversation with Adhish. Adhish, when it comes to FY25, the street is expecting an improvement in revenues as well as margins. What is the kind of revenue target that you have for this year? Volume target, if you could give that as well, rate variance, etc. And what are the kind of margins that you're gunning for on a full year basis?
Okay. So earlier, before starting this quarter, we were gunning for around, 14 to 15% kind of a volume growth. Unfortunately, because of the decline in the first quarter, the second quarter will just go in making up those lost volumes. And the second half of the year, we still feel that we will be able to post that kind of a volume growth. So on a composite level, we believe some high single-digit volume growth should be there for the entire year. We are depending on the greenfield project, which will be coming online soon.
Okay, all right. So second quarter is probably going to be weak as well. Just hold that thought, because there's, just to continue our conversation. So you're saying that the second quarter is going to go in making up a lot of the volumes that you've managed to miss in Q1. But where does that leave you in terms of the FY25 guidance? Because the last time we spoke to you, you said that there could be a 10% top line growth despite a negative rate variance of 5 to 8%. And, you're also anticipating an improvement in margins. I'm assuming there could be a tweak to this.
Yes, definitely. So because we'll be not gaining that much volumes in the first half of the year. Though second half we'll be having 14-15, but on a composite level, it will be around 7 to 9% volume growth. But at the same time, for the entire year, we also expect around 5 to 7% rate degrowth year on year. So probably that will leave us in the 4 to 6% range for growth in terms of value, as far as top line is concerned.
Okay, so just about, can you repeat that? Total top line would be how much for the entire fiscal?
So on a value basis, we'll still target for around 5% in spite of the rate decline.
Okay, all right. And margins?
Margins on a yearly basis, probably about 13% EBITDA level. But as far as the last quarter is concerned, we would definitely like to go beyond 14% for at least the outgoing quarter.
Right. You have this 600 crore Capex which has come on stream. So just wanted your thoughts on one, what more do you have in terms of Capex plans for this year and the next? And what are typically the asset turns on Capex in your industry? And because of this 600 crore coming in on stream, what's your aspirational revenue target, say, over the next couple of years?
Yeah, so at the full potential level, we should be going beyond 4,000 crores of turnover once we are able to achieve around 90% capacity utilization for the said projects. Having said that, current year we are also spending a lot on oncology product registrations, that is on the formulation side, which has a total peak potential of around 300 crores for our formulation products as well. And apart from that, we are also looking at further derivatives of certain expansions what we have done recently. So that will further increase our revenue in spec chem and intermediate segment.
Okay.
And by when does
Just-
it reach 90%?
So we will target around 3 years, 3 financial years, include so FY27 probably.
Okay. Your net debt was at around 564 crores at the end of FY24. What is your plan in terms of reduction? And do you probably have to take on a lot? Do you have to take on debt because of, say, working capital?
Yeah. So as far as the API industry is concerned, it is quite working capital intensive. Right now, we'll be sitting at around 575 CR of debt. The reason it has gone up a little bit is because of the term loans for the ongoing capex what we are doing, and also we have a little pile up in the raw material inventory which we can bring down, and our working capital can come down a little bit from these levels.
Okay, so what is the plan on reduction and what is the target on the debt?
So our debt to equity as of now, means as of June end, it was around 0.44. So our plan is that whenever we are doing capex, there will be certain quarters or years when there will be peak debt to equity, and our peak debt to equity should not go beyond 0.7, 0.8. That is our plan. But at the same time, we are getting our cost of debt is quite low. Even our working capital is around 7.5% or so. So that definitely improves the ROE. So we don't want to remove debt completely off the books, but we'll maintain it around 0.5, 0.6 debt to
All right,
equity.
just one word before we let you go. You said that you're looking to improve your working capital days by reducing inventory. What are they at right now, and what is your aspiration here?
Yeah, so we feel that around 30-40 CR can be easily reduced, and that is purely on the side of raw materials. Our raw material days have gone up slightly higher, and we can easily reduce that by around 10-15 days.
All right, Adhish.
Okay, all right, Adhish. We're going to let you go on that note. Thanks very much for joining in and speaking with us. So that is the management of Aarti Drugs. They've reduced their FY25 guidance. Earlier, they were guiding for around 10% growth to around 5% growth. The negative variance would be around 5 to 7 odd percent. And they are targeting volumes of around 5 to 7 odd percent. So they're hoping for a recovery in terms of volumes going forward. Currently, the stock is under pressure. It's down around 3.5 odd percent. Not done much this year either. We'll take a short break, but Rachna,